looking forward to this chat for a few weeks now, and frankly, it couldn't come at a better time, as our audience has been keeping very close watch on what's going on with the macroeconomic environment. Ben, I think we have an interest rate decision in Canada coming this week. Housing starts later this week, CPI in a month. Overarching theme remains, where's the growth in this economy? What are we looking for? Maybe wanted to turn the microphone to you to kind of start off the conversation with what you're looking at this week.
Yes, of course. The big story, of course, is the Bank of Canada. To what extent the Bank of Canada actually will surprise the market and raise interest rates. Why? Because we got better than expected inflation, higher than expected inflation just a few weeks ago. And the market is tweeting about the possibility of the Bank of Canada raising interest rates in June, not July. Now, this is not very likely, but of course a risk. Why? Because the Bank of Canada can raise interest rates without raising interest rates. Why? You basically say, we are going to. This by itself will take the market higher and keep monetary conditions tight. I think that's what the Bank of Canada will do. They will be relatively militant about their language. Why? Because inflation is more sticky than expected. And I think that clearly you give the Bank of Canada two options. One is inflation. The other is the recession. They will take a recession any day. And let me remind you that every economic recession over the past few cycles was helped, if not caused, by a monetary policy error in which central bankers raised interest rates way too much and killed the economy. I think that's more or less where we are going. I think that the Bank of Canada is starting to overshoot. If they are going in July, and that's very likely, they will start overshooting, but they will take a recession over inflation any day. That's more or less where we are. So the focus is on inflation, employment, wages, and clearly what's happening in the US.
Well, you've got a great tie in there, and you mentioned it already. You know, we've also got some key U.S. Economic numbers both behind us and still to come, with jobs out last week, beating expectations in the U.S. That recession theme remains very possible. Lower growth, higher inflation in the immediate term. Talk to us a bit about that U.S.-Canada economic impact and what you're looking at to kind of bridge that world together and come with that opinion on
yes,
the Canadian
absolutely,
side.
absolutely. The U.S. is, again, doing better than expected. We're talking about roughly 1.3% GDP growth in the first half of the year. The second half will be about zero in both Canada and the U.S. So clearly the economy is starting to react to what's happening when it comes to interest rates, but with a lag. The market expected this recession in the second quarter. I'm sure that all of you are disappointed that we didn't get it. We might get it in the second half of the year. But again, as far as I'm concerned, this is not a real recession. This is a wannabe recession. Basically a situation in which the labor market is still fine. To me, if there is no blood in the labor market, it's not a recession. It's a wannabe recession. So we might get negative GDP growth here and there in the second half of the year, but that will not be a real recession. You need to see blood in the labor market. The labor market is very, very tight at this point. So we are focusing not only on labor, but also on wages, the unemployment rate, the quality of employment who is being hired. And I think that if you look at the numbers in the US, clearly better than expected. One survey, another survey, the household survey, is actually worse than expected. The unemployment rate is up. And one thing is happening. All those vacancies that you read about, 10 million in the US, 1 million in Canada, it's one big mirage. One big mirage. It's very easy. You press a button, you say, I need 5 people. It's not costing you anything. Show me the money. Economics 101 is telling me, if you have a shortage of something, the relative price of this something will rise. Basically a situation in which the wage of bottom 20, bottom 40, because that's where the demand is, should rise faster than any other segment. It's not happening. It's rising, but nothing to write home about. Show me the money. If you're not willing to pay, you don't need those people as much as you think. And therefore, I think that this economy will be bleeding vacancies as opposed to jobs.
Which, as an indicator from a Canadian perspective, I know unemployment has remained flat. I think we're month number 6 in a row now, which seems to lend itself to your comments precisely that maybe a real recession isn't exactly in our immediate future.
Absolutely. The market is tight, and part of it is demographics. Now, I think that we have to realize that a lot of things are happening in the labor market, and it's big things. Whatever you do, regardless how you invest or you don't invest, and whatever you do and you don't do, you have to ask yourself the following question. To what extent COVID is an event or a condition? clearly, let's hope and pray that medically speaking, it's an event. Economically speaking, it's a condition. So many things were accelerated, e-commerce, de-globalization, working from home. We know the story. One of them is the labor market. Listen to this in Canada. Since the beginning of this madness, we generated 900,000 new jobs. All of them, listen to this, all of them, 100%, not 99, 100% were university educated individuals. Because I believe that COVID opened up the labor market for educated people. Because in the past, you were educated in Toronto, you couldn't find a job, you were serving coffee at Starbucks. Today, you're educated in Toronto, you couldn't find a job, you find it in Alberta, BC, New York, Zooming. COVID opened up the labor market for educated people, but nobody's left to serve coffee. So the point that I'm making here is that the people that are entering the labor market are high wage, high education. People that are exiting the labor market through retirement, and we are in a wave of retirement, low wage, low education. That's why the share of low-paying jobs going down. This is a major restructuring of the labor market that we have to understand from an investment perspective.
So the interesting thing there as well is it's a global market. It's not just industry sector or locally relevant anymore. You're actually looking, in fact, a lot larger than just the Canadian or local market context.
Absolutely, but at the same time, something else is happening, and that's deglobalization. We estimate that about 20% of what the US is getting from China now will come home. Because we know that, the COVID accelerated the process of deglobalization with major implications. You wake up one morning and you realize that 90% of your antibiotic supply is coming from China. That's not going to continue. Now, it means that the work is coming, but not the workers. That's another reason why the labor market will be tight.
Interesting. And certainly we're seeing some of those in discussions we're having with partners today and some of those earlier indicators in the business. Now, I want to come back to something you said, though, about employment specifically. When you look at it, what is actually interesting is obviously people have jobs, they're earning money, they're spending money. And you mentioned that pent-up demand factor driven by COVID and where we're kind of seeing consumer spending going now. Can you talk to us a little bit along the theme of our event today around inflation, the impact on inflation, and what consumers are doing to either contribute or drive the economy forward?
Yes, absolutely. So first of all, we have to realize that this inflation rate, in fact, will be going down over the next few months because of what we call a base effect. A year ago, prices were rising very fast. So on a year over year, when it's being dropped from the equation, it's actually going down. So until September, I believe, the trajectory will be actually lower inflation on a year-over-year basis. But the consumer is clearly a very big part of it. One of the reasons why we didn't get this recession that everybody promised you is because of the fact that the consumer has been sustaining this economy. Why? Because this consumer is loaded. This consumer is loaded. $165 billion of excess cash sitting on the sidelines in deposit accounts. Why? We all know the story. During COVID, people were not spending. They got their money. The checking accounts got bigger and bigger. Now, this is happening, and the pent-up demand was utilized and satisfied by this money. However, two things are happening. One is that people are blinded by the 5% GIC. So you see the money that is sitting in checking account going to GICs like there is no tomorrow. So actually, it's negative growth in checkable accounts, very strong growth in GICs. This means that the money is not as liquid, therefore not available for spending. But that's one thing. The other is the distribution. In the beginning, over the past year and a half or so, all this money was held by everybody, including low-income Canadians. I'm thinking now, based on my numbers, is that the low-income Canadians utilized or basically spent most of this excess money. Namely, they will not be able to continue to support the economy. In fact, we believe that roughly 95% of this excess money is held by the top 20 wealthy people, and their propensity to spend is not very high. And therefore, this means that the consumer, although will be there, will not be able to sustain the economy the way they used to over the past 6 months. And that's the reason why we believe that the next month, the next few months, the next few quarters will be relatively low growth, maybe close to zero.
That starts to make things really interesting. And you raise a great point on cash and liquidity. Ultimately, that higher interest rate is certainly attractive, especially when you've just got money parked, you're not sure where to put it. For a moment, as you're thinking about GIC rates, and they've obviously lifted nicely over the last couple of years as the Bank of Canada has lifted our overall Canadian overnight rate. Where do you see that trending to in maybe not the first or the last half of this year, looking at next year, 2024? What do you see as the trend there?
Yeah, the Bank of Canada and the Fed, what they're going to do. So I think that the likelihood of the Bank of Canada raising in July is very high. I think that the likelihood of the Fed raising in July is very high. So let's call it another 25 basis points.
Mhm.
So the bank will raise at 475. Fine. Overshooting, but not a disaster. I think we should just stop at about 425. But that's okay. As long as you don't go to 5.5, then you are fine. The next question is, when are you cutting? Now, until very recently, the market was pricing in a situation in which the Bank of Canada and the Fed will be cutting in the second half of this year. I'm not sure what the market was smoking, but clearly that's not the case, not even close. And I think that what we are going to see, because of this sticky inflation, we are going to see a situation in which the Bank of Canada will stop at 475, but will keep it there for a while. What is a while? Try second half of 2024 for the first move. That's a possibility. So you cut into 2024, second half, into early 2025. But then where do you rest? We started this at 175. We are going to 475, we rest, and then we go down. Where do you stop? Maybe 2.5, maybe 3. Basically, almost 1% higher than before, because there are all kinds of inflationary forces happening. We have deglobalization that is inflationary. We have just-in-case inventories, that's inflationary. We have a labor market that we discussed, that's inflationary. All those green initiatives, that's inflationary. So you have 4 inflationary forces cooking. The target is 2%. We can discuss until we are blue in the face. To what extent this 2% is the right number? Not going to change. I can tell you now. 2%. Same target, 4 inflationary forces. By definition, interest rates will have to be higher. How much higher? I say a full percentage point higher than the 175 that we started this madness in.
It's going to be interesting, and I think as rates start coming down, obviously that cash comes out and starts being used to invest or to consume wherever else investors may wish to put it to work. It's actually a bit of an interesting topic as well, thinking about it from your perspective, looking big and not just at Canada. Where do you see some of the broader, maybe I'll say either sectors or industries or types of businesses that perhaps our investor base should be thinking about as we work our way through that next 6, 12, 18 months in the investment cycle?
First of all, I think that we have to realize that one thing will happen eventually, and that's companies will be starting to spend money. Because all those forces that I talked about, deglobalization, just in case, labor, green, they are all also impacting the profit margins. Profit margins are going down because, profit was easy until now. So now, for many CEOs, you have 2 options. One is to look at your margins shrinking. The other is to do something. They will do something. And this something will be to replace labor with capital. You will see a situation like we have seen in the 1990s during the dot-com revolution, where wages went up, but inflation didn't go up because productivity went up because of investment. That's exactly what we're going to see. Not in 2024, but probably in 2025 and forward. I think that we're going to see major injection of money into investment, productivity. And remember, productivity is the number one protection from inflation. I can give you a 10% increase in your wage and you're 10% more productive. That's not inflationary. So first of all, I will focus on companies that are able to replace labor with capital. If you can do that, you will be ahead of the curve. I think that interest-sensitive companies will start doing well within the next few months when we get a sense that the Fed is done, the Bank of Canada is done. They will start tweeting about the possibility of them cutting, and that will be a possibility. So I think that actually interest-sensitive companies will do extremely well alongside companies that are able very quickly to replace labor with capital.
And that's an interesting one when you think about your earlier comment also around employment and unemployment. As you start developing that tech, obviously pay your people that stay longer, but that investment in technology obviously encourages or forces some employees to go and find new work in other industries that maybe haven't advanced as quickly, ergo the rest of the economic cycle as per usual. Do you see anything different about this one, given obviously we've got a lot of people kind of encouraged and able to work remote, anything that you would say is different versus something that's happened maybe in the past as an economic
Yeah,
event?
I think that the process of replacing labor with capital will be much faster than any other time in history. Remember, we're all aware of the AI scenario and what it means. Regardless what happens, there will be losers and there will be winners. And I think there will be some losers, unfortunately. I think that that will lead to some widening in the income gap, but you cannot fight it, unfortunately. So I think that's more or less where we are going. But absolutely, I think that you will see a movement of labor. And again, I think that the companies that are able to accelerate the process and reduce the downward pressure on profit vis-a-vis automation will be the winners here.
Makes perfect sense. Now, I've got one tie-in question related to this, and you're sitting in Canada, obviously, with one of Canada's largest banks. Do you see the same opportunity, same impact, same change evolving in the US in particular as our closest neighbor, or is that something different you see unfolding there?
Yeah, I think more or less the same with one big difference. There, the shortage of labor is worse. Why? Because of immigration. Canada is taking 6 times more new immigrants than the US per capita. 6 times more. We are getting roughly 470, close to 500,000 a year. This is just new immigrants. In addition, we have non-permanent residents, students, roughly close to 1 million people entering. Now, this is causing major issues in Canada when it comes to infrastructure, health, and mostly housing. The housing market is on fire in Canada because of the increased demand. We don't have the supply. We're simply not building enough, not building quickly enough. We all know the story. We all feel the story. The housing market is crazy and will get even crazier. In the US, because of the lack of immigration, you don't have the same pressure, but also it means that the labor market is not as supplied, as well supplied as in Canada. That's something that we have to take into account.
So that's interesting. You're suggesting then that in Canada, we're going to see a much more noticeable, or I'll say sharper kind of move here because our market's much tighter than perhaps the US in this case.
Absolutely. I think that we are going to see a situation in which, although the labor market in Canada is tight, it could have been much tighter if we didn't have those immigrants. In the US, that's the case exactly. And that's why in the US, one of the reasons why interest rates in the US will have to go higher relative to Canada.
Now, I know obviously we track our neighbors to the south very, very closely. And I think there was a lot of speculation maybe 6-9 months ago as Canada kind of advanced that agenda on interest rates a lot faster than I think the US Fed did. And we've obviously kind of tapered back a little bit as they've caught up. Do you see, thinking about your indicators going forward on interest rates, a bit more of a lockstep adjustment there? Or are we really going, as you suggest, US has got a little more room to move. Canada, we're going to kind of manage our own situation separately?
Yes, the question is to what extent the Bank of Canada can divorce itself from the Fed. And the current spread between the Fed and the Bank of Canada is 50 basis points. Before the crisis, it was 75 basis points. So it's within the range that the Bank of Canada can tolerate. If this spread goes to 100 and more, the Bank of Canada will have to follow the Fed because of the impact of the Canadian dollar. I don't think that would be the case because remember, the banking stress in the US, namely what we are seeing there with the crisis in the banking sector, is acting as higher interest rates because small regional banks are not lending. This lack of credit is acting like higher interest rates. We estimate roughly 50 basis points. So the Fed is actually raising interest rates without raising interest rates. And that's why the Fed can go another 25 basis points and call it a day because you got another free 50 basis points from the banking sector. I think that's the way to look at it.
Interesting. In fact, reconfirming perhaps what you already know, but for our investor base, there's really no one single lens to look through to get kind of this macro overview and dig into the various impacts. And in fact, it is quite a complex one to untangle when you start pulling out all of these different threads affecting, or not only Canadian, but global economy. You hit on one in particular that I know as Canadians, we like to buy global, and a lot of our Canadian dollars end up making it into the US, whether that's by owning stock or by travel or just by proxy of consuming goods that are produced in the US and come to Canada. Can we talk a little bit about the Canadian US dollar kind of setup and where you think that's going to go, not only from where we are now, but considering all the things you've shared with us over the course of this conversation with kind of the next 6 and 12-month periods where rates are likely going to adjust? What do you see coming for us?
Yeah, so the Canadian dollar, of course, currencies have their own mind. Nobody can predict currencies. We all know that. They go their own way. However, I think that we know that at any point in time, the value of the Canadian dollar is impacted by two things. One is commodity prices, especially oil. The other is the spread between Canada and the US in terms of interest rates. I think that the commodity market will be neutral for the dollar for the next 12 months or so. So it will not be a major factor. So it's really about the Fed and the Bank of Canada. I think that as long as the market is tweeting about the possibility of the Fed moving, the Bank of Canada will have to look at it. And the market will basically make sure that the dollar does not go very strongly up. As long as you have this uncertainty about the Fed, the US dollar will remain strong. However, I think that by September, October, it will be very clear that the Fed is done. The Bank of Canada is done. The market will have a view about when they're going to cut. At this point, with the reduction of uncertainty, you will see the Canadian dollar starting to gain some ground. So my forecast, and it's a guess, over the next few months, you will see a situation in which the Canadian dollar will be relatively stable, going nowhere, and then will regain 1 or 2 cents against the US dollar as the US dollar in general starts going down and the market is not tweeting about the possibility of the Fed moving again.
Interesting. So we're really then watching September, October window for something interesting. And to your point, it's interest or your overnight rates stay flat at that point, some kind of an indicator that we're done lifting rates. And that's when you start looking at it from a currency perspective.
Absolutely. I think that's the way to look at it.
Tremendous. And that's good insight. You know, as you're kind of thinking about this from an investor perspective, you know, when you buy US, you end up buying 2 trades. You own the underlying investment that you acquire. 2, you own the currency risk over the long term that you hold that asset to the extent you want to convert. So 2 things that obviously investors are 2 trades rather that investors need to keep in their back of their mind as they're deploying that capital now through the summer and certainly into the fall as rates start maneuvering around again. Ben, we got an interesting question from the audience, and it was one that you touched on at various points through the course of our discussion around Canadian housing in particular. How do you see that correction coming? You mentioned, you know, kind of tight, not enough buildings in place. At the end of it, you know, a lot of consumers are probably sitting on the sidelines a little bit right now. The question really is, why is it not reacted to that higher interest rate setup? Keen to get your thoughts.
First of all, we have to understand what happened during COVID when prices went up by 46% in 2 years. It was the asymmetrical nature of the crisis. All the jobs that were lost were low-paying jobs, young people, renters. That's why rent actually went down. For home buyers, their income was there, their position was there, their job was there, interest rates were in the basement. So to understand the housing market during COVID is to say that home buyers got the benefit of a recession vis-a-vis extremely low interest rates without the cost of a recession vis-a-vis a broadly based increase in the unemployment rate. We have never seen anything like that. There was a sense of urgency to get into the market. And when there is a sense of urgency, you basically front load activity. You borrow activity from the future. That's exactly what happened. And the future has arrived. We are in the future. This is not a correction. This is reallocation of activity over time. And as you know, the market is starting to stabilize now, maybe prematurely. It is stabilizing mostly for relatively cheap or less expensive units. In Toronto, for example, something between 800K and 1.2 is, you know, going very fast. Over 1.5, much more slowly. So this is not a normally functioning market yet. Clearly, still, there's a affordability issue. And at the same time, every year, last year, we got 950,000 new people into this country. Non-permanent residents, permanent residents, students, people from the Ukraine. This year, it's going to be 1.1. None of them is carrying their house on their back. None of them is carrying their house on their back. None of them. This means that we have a situation in which demand is rising very quickly. Supply is not. We are in an affordability crisis. So the short answer to this question is that the housing market is stabilizing now. That's very healthy. In fact, I think it should go down a little bit more, but that's not happening. Stabilizing. But if you ask me where it will be 2 or 3 years, 4 years from now, without policy action, it will be higher and tighter, and that's not a good thing.
Yeah, it's as you suggested earlier, it's back to economics. Supply and demand are not working in favor of the end consumers trying to buy into housing right now. rates may be stable. We know where they're headed. You've got lack of supply, and that's ultimately going to cause prices to move around as and when people start re-entering the market.
I think we are in a major crisis. We have to wake up. We have to wake up because a generation of Canadians are priced out. And part of the solution must be a rental solution. We need to provide incentives to purpose-built rental builders, namely developers that will not go with condos, but apartment buildings. But for that, you need incentives. That's a very complicated issue. But regardless what we have to do, we have to wake up because we are in a major crisis, quite frankly.
It's one certainly to be watchful of. Ben, we've been poking around at you across a myriad of different topics, and obviously time flies when you're having fun. It's hard to believe we're almost at the end of our spot together. I wanted to leave you with basically 60 seconds towards the tail end of our presentation. And we've talked about a lot, everything from interest rates, rate cycle changes, the Bank of Canada overnight rate, employment, recession. How do you kind of sum all of these pieces up together when you're kind of thinking about, you or me sitting at home looking at our personal accounts? What am I looking at when I'm staring at my investment portfolio? How do you wrap all of that together for us in 60 seconds or less?
Yes, it's very complicated, but I think that the focus should be inflation. Inflation is really the number one story. If inflation starts slowing down in a reasonable trajectory, I think that all the worries about interest rates will disappear and the market will take off. So my focus is inflation. But when it comes to inflation, you really have to know what you're looking at, not the headline numbers that you read in the newspapers. And if you look at some forces of inflation, they're actually moving in the right direction. We have a situation in which if you look at supply chain is improving dramatically. Food prices, energy prices on a year-over-year are actually going down over the next few months. If you look at like rent is actually in the US starting to go down, which is a major, it's 40% of core CPI going down. Even the labor market, if you believe that all those vacancies is one big mirage, even in the labor market, wages are not rising as quickly as they should. So overall, I think that we are seeing some disinflationary forces that will lead to a situation in which inflation can reach about 3% over the next 12 months. That would be a very positive signal to the market that the crisis is over. So focus on inflation, but do your research. It's not just headline inflation, it's what's in the pipelines, because inflation is a lagging indicator.
That's an important and sage piece of advice for our investment audience. And Ben, certainly appreciate you sharing that top of mind lens with us today. And in fact, it is incredibly hard to believe because we are fresh out of time on our conversation today. To our audience, wanted to thank all of you for joining in, for your questions and commentary. If we didn't get to your question today for some reason, drop it in. Don't worry, we'll try and get a response out of Ben back for you. Ben, obviously it's been an absolute honor to have you here with us today and really enjoyed our conversation. I'm confident our audience got a ton out of this, and at the very least, a viewpoint on how to look at both the macro and some of the more micro or mid-market sections of the economy in the meantime. So thank you very much for joining us today.
A pleasure and good luck. Talk to you soon. Bye-bye.